Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. US Supreme Court has struck down Trump's decision on tariff. But after the verdict, Trump announced that he is going to charge tariff under Section 122 to an extent of 15%. On one hand, we have got a good news that Supreme Court has disallowed tariff. On the second end, we have got a news which can be taken as little negative, as Trump will continue to charge tariff rate of 15% for 155 days. Conclusion is market will have uncertainty, and whenever there is uncertainty, it is taken as negatively by the market. So expecting equity market to sell off again and dollar to get stronger after this news. Now our thesis is that dollar index is going to rise towards 100 level. Let me give you data points which is supporting our thesis. So the first data is US labor market data. I have to classify the data into three parts. First, initial jobless claims have been decreasing. Second, unemployment rate is at 4.3% versus 4.5%. And the third data point is non-farm payroll, which is increasing and best since 2024. Underlying factor is suggesting that US labor market is strong. Second indication is how US industrial production is doing. If you see the chart, industrial production trend is on a rising trend. Second, now the third impact is how is inflation in US is doing. So if you see the data of core PCE inflation, inflation is on a rising trend. Now there can be two aspects. If inflation is on a rising trend, Fed might not go and reduce the interest rate. Even if it is going to reduce the interest rate, the new Fed governor have a different thought process with respect to Fed balance sheet. Let us understand that. Kevin Walsh, who is going to become the new Fed chairman, his thought process is that Fed has to reduce its balance sheet drastically. It means that they are going to do quantitative tightening. If quantitative tightening is taking place, it means that fewer dollar will be in the system. As a result, when the supply of any commodity is lesser, its value rises. So basically, Fed can go and cut the interest rate, despite that dollar will become stronger as supply of dollars will be lesser. And the last but not the least factor is escalation between US and Iran. If escalation increase, it can make dollar little stronger. So basically dollar index, which is currently trading near 97.80, will have a strong support between 96 and a half to 97 kind of a level, and we are expecting dollar index to move towards 100 to 100.50 kind of a level. That is our first target. If that level is broken, then we can move higher towards 102 kind of a level. Outlook on rupee. Because of US Supreme Court decision on tariff, it can bring some amount of positivity, and because of that, we might see some 10-20 paisa appreciation in the rupee. But saying that, there are several factors which is still negative for rupee, like dollar index can move higher, crude oil prices are on a upward trajectory. Third, trade deficit for the month of January was at 34 billion versus 25 billion for the month of December. RBI is still having a short position close to $62 billion, and FIIs have been continuously selling in Indian equity market. Because of all of this factor, pressure in rupee is going to continue, saying that 90.60 to 90.80 is going to act as a strong support for the pair, and eventually the pair is likely to move towards 91.20 to 91 and a half kind of levels. Discuss strategy for thin margin exporters like agri exporter or chemical exporter. Most of them are taking costing between 90-20 to 90-40 kind of a level. We'll suggest them that they can cover 60% of their exposure near 91 kind of a level. For remaining exposure, they can keep a stop loss of costing or 90.20, whichever is higher, for a target of 91.20 to 91 and a half kind of levels. Let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. For them, we will suggest they should wait for some more time and target initiating their hedges between 91.20 to 91.50 kind of levels. Let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. For them, we will suggest they should wait for some more time and target initiating their hedges between 91.20 to 91.50 kind of levels. Let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. For them, we will suggest they should wait for some more time and target initiating their hedges between 91.20 to strategy for importers. Most of the importers we have suggested that they should cover their next 50 days import between 90.20 to 90.40 kind of levels. But if anyone was not able to cover at those level, to them we will suggest that any dips towards 90.60 to 90.80 should be taken as an opportunity to cover their imports for next 50 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.